full draft of the long-awaited tax bill has finally been released this week, and it includes a lot of interesting provisions for real estate investors, business owners, and people in general. I expect the bill to be marked up and edited before getting passed later this year, but I wanted to go ahead and record a video to walk you through some of the proposed tax changes in the bill and what they might mean for you. Grab a drink, take a seat, and buckle up because we're going to crank through a lot of this very quickly. And before we get going, just remember that these are proposed changes. The House will send this up to the Senate, who will make their own edits before passing it back down to the House and then on to the President to sign. We expect many changes to come. All right, the first big one for real estate investors and business owners is 100% bonus depreciation coming back online. Retroactive to January 19th, 2025, any rental you buy or purchases you make for your business that are placed into service on or after January 19th will be 100% bonus eligible. This is a huge deal for real estate investors and business owners as it makes capital purchases more economical given the tax savings. It's also a huge deal for anyone in the manufacturing space given the new qualified production property that will also qualify for 100% bonus depreciation. This covers manufacturing, production, or refining of qualifying products, but not office use services, parking, etc. 100% bonus will remain in effect until the end of 2029. So far, it's not been proposed to make it permanent, but there are rumors that the Senate will make that change. Another big one is increasing the state and local tax deduction, or the SALT cap deduction. This bill includes a $30,000 SALT cap limit, which is higher than the current $10,000 cap. But don't get too excited, this is a very expensive proposal, and I do expect it to get sliced up, maybe even removed. All right, moving back along, we have changes to the excess business loss rules. This one's tougher to understand, so lock in and stick with me here. Under current law, if you have a business loss that exceeds your business income, you have to review your exposure to the excess business loss rules. This generally happens when W-2 employees generate a business loss or a large loss from investing in rental real estate. It can also happen when you have a large capital gain event from a stock sale and you're trying to use rental losses to offset that gain. So here's how it works. Let's say that you have $700,000 of W-2 income and capital gain from stock sales, and you buy rental real estate, you cost seg the properties, and they generate a $700,000 tax loss thanks to that bonus depreciation. The problem is your W-2 and capital gain income is not going to be considered business income. So your entire $700,000 loss is considered to be a business loss in excess of business income. The excess business loss rules say that a married filing joint couple can only claim $610,000 of loss in excess of business income, at least for 2024. So in this case, even though you have a $700K tax loss from real estate, you can only claim $610,000 of it. The remaining $90,000 is carried forward as an NOL, and most people can use that NOL in the following tax year. And that's where this proposed change comes in. The change reconsiders the NOL treatment and basically makes it much harder to use the excess business loss that you're carrying forward into the future. Not impossible, just a lot harder to use. For the next proposed change, QBI is getting a boost. The Qualified Business Income Deduction, or QBI for short, allows business owners to basically reduce their net profits by 20% when calculating their tax liability. I won't get into the nuances in this video, but the current proposal is to allow for a 23% deduction rather than a 20% deduction. The House has also proposed a change to R&D expensing. Currently, software companies must amortize their R&D costs, which basically is all of their costs. So this proposed change enables software companies to fully deduct their R&D costs in the year that they were incurred, which is a great change if we want to beat China in the AI race. This bill does kill the pass-through entity tax workaround or loophole that many sophisticated investors and their accountants have been deploying. With the SALT cap limits of $10,000, many states allowed business owners to pay their individual state income taxes through their businesses and receive a business deduction for it. This proposal kills that PTET workaround and eliminates Notice 2020-75, which ultimately closes the loophole. To continue being a bummer, the proposed changes related to QOZs weren't as great as we hoped. There's no deferral for 2026 capital gains, which effectively puts the entire program on pause. You can get a 10% step up in basis if you hold for 5 years, but there is no 7-year threshold like there was in the original 2017 TCJA. The full 10-year step up is still available, and interestingly, they will allow you to contribute $10,000 of ordinary income rather than strictly capital gain income. Green credits are expected to get rolled back. This is a big pay for the bill. Details are still emerging, but it's clear that the bill is slashing and restructuring many green energy credits. Transferability is likely dead, which is a huge blow to renewable energy deal flow in that entire sector. Next, we have a proposal to allow for auto loan interest deduction for your personal vehicles. This provision would last for 4 years, and it allows for up to a $10,000 deduction for interest paid in connection with car loans. There are income requirements, and your allowable deduction does phase out the more money you make. In a win for families, there's a proposal to establish a new account called the MAGA account, which stands for Money Account for Growth and Advancement. It appears the government will seed the account with $1,000 once you establish it for your child. Qualifying children must be born between 2025 and 2028, and parents can contribute up to $5,000 per year, but you can't distribute the funds until the child turns 18, at which point the funds can be used for higher education, small business loan related expenses, and first-time homebuyer costs. So let's do some math here. If you contribute $5,000 per year for 18 years, assuming an 8% growth rate, then when your child turns 18, the account balance will have grown to around $190,000, which is a pretty solid start to life, if you ask me. Another big proposed change is jumping the expense cap for Section 179 expensing up from $1 million to $2.5 million. Many business owners and real estate investors benefit from Section 179, so that's a good win for businesses. And lastly, charitable contributions are sort of back. Remember the $300 above the line deduction from the COVID era? This was the one deduction that if you didn't itemize your deductions, you could still claim this charitable deduction. Well, the bill proposes bringing this back, and it offers a deduction of $300 for single filers and $600 for married filing joint filers. In summary, remember, this is just a draft. I expect many changes will come over the next few months, but there are some interesting provisions that I think will stick, especially bonus depreciation. I highly recommend that you subscribe to our email list with the link in the description below this video so that we can keep you updated. And if you're feeling like you're not taking full advantage of the tax code, there's many ways to retroactively save you on taxes. When we onboard new clients, the first thing we do is look through prior returns for missed opportunities, and most of the time we find something of value. So feel free to schedule a free consultation with my team by clicking the link in the description below. We work with thousands of real estate investor clients across the United States, and we have found most people switch accountants because they aren't getting proactive advice from their CPAs. We meet with clients several times a year, and we build customized tax plans based on your current income streams, assets, and your goals. We're very effective at helping clients reduce taxes. My name is Brandon Hall. I'm the CEO of Hall CPA. I hope you liked this video, and I'll know you did if you can do something for me. Comment, like, and subscribe to my channel. I'll see you next time.